In today's video, we're going to talk about how to calculate capital gains tax when you sell a rental property. Now, if you're new to my channel, on this channel, we talk about real estate investing, personal finance, as well as career building. If these are of interest to you, consider subscribing. Now, first, before we get into the video, I just want to put a disclaimer out there. I am not an accountant. I am a real estate investor and I'm a realtor. I've sort of had these discussions with my clients when it comes to selling their rental properties, and I've calculated it on my own when I've sold my own rental properties. But definitely, if you're going through this process and you have a good accountant, definitely have a conversation with them and go over what the tax implications of a sale of a rental property will be. So let's start with a quick definition here. What is a capital gains tax? Now, capital gains tax is a tax on a sale of a property or an investment. Now, if you are selling your personal residence, the property that you live in yourself, that is a single family home, and it's your personal home, there is no capital gains tax applicable in Canada. However, when it comes to secondary homes such as cottages, or when it comes to investment properties where you buy it for the sole purpose of renting it out and owning as an investment, when you sell it, if there is a capital gain or a profit on the sale, you are required to pay taxes on that amount. Now, for any of you who are wondering, the 1031 exchange does not apply in Canada, and the 1031 exchange is a benefit available to our American friends who are able to essentially defer the capital gains on the sale of an investment property if they roll it over into another investment property. I believe within a short time period, like 6 months or so, they are able to defer the capital gains until the eventual sale of the next property, so they can keep rolling it over, which is actually quite a nice benefit if you're trying to grow your real estate portfolio. Unfortunately, in Canada, that doesn't exist. So when it comes to the capital gains tax, let's start with a key concept. It's a little bit hard to wrap your head around it, but it's called the 50% inclusion rate. So to explain that fully, let's go into a quick example here. So in this example, we're gonna have a property we're selling for $650,000. We're gonna have about $36,725 in real estate commissions. We're gonna have closing costs about $1,500. So our net proceeds are gonna be $611,775. And we're gonna assume that, for round numbers, the investor purchased this property for $311,775. So we have a total capital gain of $300,000. This is the profit this investor has made from owning this property over however many years it's been. So let's start with example one, Bob the professional. So Bob is doing well for himself. He makes $150,000 a year, solid income. In his scenario, what happens with the 50% inclusion rate is that of this $300,000 profit, half of that, so $150,000, will get added to Bob's personal income for the year that he sells this property. So this results in Bob paying an additional $76,755 in income tax that year. And if you consider that $76,000 as a percentage of the entire capital gain of the whole $300,000 of profit, he's essentially paying about a 25.6% tax rate on the total amount. So this is pretty much as high as the capital gains tax can go. Because of that 50% inclusion rate, when it gets added to your personal income, we have a progressive tax system here in Canada. So the more income you make, the more taxes you pay, but it kind of caps out at around 53%. So technically, the most capital gains tax you can pay is going to be about half of that. So about 26%, 26.5% is roughly the max that you would ever pay in a capital gains. And in Bob's scenario, that's pretty much what he's going to pay. So let's look at example two, Sue the retiree. Now Sue, made good income as a professional, but she has now retired. She doesn't have a pension. She didn't bother putting any money into RSPs or anything else to draw an income off of. So she's solely relying on the government, and she's making $20,000 a year as a result. She still owns the same investment property. In her scenario, when this property gets sold, the same $300,000 profit is what she makes, half of which gets added to her income. But however, like I mentioned, because in Canada we have a progressive tax system, since her income is only $20,000, the $150,000 gets added to that. So that specific year, she makes $170,000. However, the earlier stages of the tax brackets are taxed at much lower rates. So as a result, her taxes end up being around $53,000 $588, which again, as a percentage of the total profit that she's making, is about 17.9%, much less than what Bob had to pay, closer to 26%. Now, finally, in example 3, we have Ricky and Jane, a working couple. So both of them, work blue-collar jobs. They make $40,000 each, and they own the same investment property. In this case, something unique is going to happen. Even though they make more income each than Sue, they actually make double the income as Sue, because they own the property together. When they sell the property, the capital gain is attributed 50-50 to each of them because they co-own the property. They're partners. They may be a couple, but they're still essentially business partners on this property as well. So each of them get to take half of the profit. So as a result, instead of the $300,000 being divided in half and then added to one person's income, that half, the $150,000 of income that needs to be added to a person's income, gets divided again in half between Ricky and Jane. So as a result, only $75,000 gets added to each of their incomes. And again, because we are in a progressive tax system, that $75,000 doesn't push them to the highest tax brackets. And as a result, their total taxes payable in this scenario is under $50,000. It's $49,458, which as a percentage of the total capital gain is just 16.5%. So as a result, they're actually able to pay a lower tax rate than even Sue the retiree, because they're able to split it in half between two people and share the tax burden on two people. So if you want a rule of thumb, if you're considering selling a rental property, I would say estimate that you're going to pay anywhere from as low as probably around 15% to as high as about 25% in terms of the capital gains. Now, this is obviously very case by case. So if you're making a massive capital gain on a property, say you've owned a property that you've held for the last 20 years and it's gone up by close to $500,000 or $1 million in profit, you're likely going to be all the way up at that 25%. And in the flip scenario, say you make $40,000 a year and you have a property that you've only owned for a couple of months where you've only made, say, a $10,000 or $20,000 profit, you may pay as low as a 10% tax when it comes to capital gain. So next, let's talk about the BRRRR strategy and how it impacts capital gains. Now, I know a lot of you investors love the BRRRR strategy, which is the buy, renovate, refinance, and rent strategy, where you try to pull all your money out after you renovate a property to reinvest it into the next property. And when you refinance money out of a property, since it's a loan, you're not taxed at all, right? So you take the full profit, you're able to redeploy it. However, when it comes to selling a property, there's some critical implications that happen once you've already pulled out your entire down payment from the property. So let's get into that. So let's look at that same example where this investor has a property they are selling for $650,000. They're going to pay 5% in real estate fees. They're going to pay closing costs, except that their mortgage on the property is $450,000. Now, if you keep in mind, they bought the property for around $311,000. So their mortgage on the property is higher than their purchase price, meaning they've gone into the property, refinanced, taken out the entire down payment and probably then some, right? So they've taken a good chunk of profit from the property already. So in this scenario, when they sell the property, they will have about $161,000 in profit in cash in their bank account. However, they still need to pay the tax on the entire $300,000 of profit. So that other portion doesn't just disappear because they've refinanced it previously. They still need to pay tax on that, even if that money has already been spent on another investment. So if we go back to Bob the professional, in his scenario, he's making $150,000 of income. He's going to pay that same $76,755 in capital gains tax, like we calculated before, except that he has to pay that from the sale proceeds of $161,775. So as a result, after selling this property in his pocket, he only stands to get about $85,020, which it's still a good chunk of change considering he's pulled out his entire down payment, he's pulled out some extra profit, he may have reinvested into some other properties, and he's now still able to sell this property at a profit. However, you have to kind of weigh the pros and cons, right? If he's selling a $650,000 asset and he's getting $85,000 in his pocket, can he go out and buy another $650,000 property? Likely not. So when it comes to selling a property, you have to be very clear why you're selling the property. And the reason for that is, say this property is a single family home that was breaking even or maybe having a negative cash flow. And say Bob has this goal of creating some positive cash flow with his portfolio, wants to reduce his risk, wants to buy, duplexes, triplexes, fourplexes, and create more of an income from his investments, it may still be the right move to sell off this property to remove a liability. Say, for example, Bob is in the stage of his investing where he wants to start simplifying his life, where he wants to take, say he owns 5 properties and he wants to sell off 3 and condense it down to 2, maybe pay off some of the mortgages, right? Or maybe take some of those profits and enjoy it, be able to retire. So in that scenario, it would still make sense to sell the property, even though there's quite a large capital gains tax applicable on the sale. So it really comes down to why you're selling the rental property that's going to help you decide, does it make sense or not? Because the capital gains tax is always going to be there when you sell a property. There's no real way to avoid it altogether. There are some techniques that you'd want to chat with your accountant about, where if you have a portfolio of properties, say a few properties, and you're selling only one, you may be able to depreciate the other properties to reduce the taxes you pay in 1 year, but you will eventually pay the taxes when you sell those other properties. It's a slight deferral of the capital gains, but it's not that much. You'll still pretty much pay the full or most of the capital gains tax in that scenario. So I hope you found this helpful. Just a quick tool on how to calculate the capital gains when it comes to selling a rental property. If you have any questions, feel free to comment below. If you are considering selling a rental property, check out my free guide that I have in the link below of the top 5 mistakes that I've seen many landlords and realtors make when it comes to selling rental properties. Selling a rental property is not the same as selling a personal home. There's a lot of moving pieces that you have to consider, and I've seen in some of the examples I put in that report, I've seen landlords make mistakes where they've lost up to $100,000 in potential profit because of making one of those 5 mistakes. So definitely check it out if you are considering selling a rental property. I hope you found this helpful. All the best. Take care.